Folks, welcome to the chart of the day from the Contrarian Trader. This is Bob Desmond. It is March the 7th. The market is now closed. And I have received a bunch of emails from non-members asking for more material to get to know me better, more videos, etc. I usually only do them on the weekends, and I have a lot of requests for more engagement. So I'm going to try to do that moving forward. And I would encourage you, if you're watching this on social media, to opt into my email list on the website. You will not be spammed and you will not miss any of the videos. So I'm going to try to keep these brief. And for new technical traders, I'm going to add a quiz at the end of today's video. If you can give me feedback on whether or not you like it, whether or not you like the video, what I could do better, etc., please do so. Just reply to the email that I sent you out, or if you're just coming to the website and viewing this video for the first time, just click on the email address at the top of the page and send me an email and give me your feedback. And if you're not happy with receiving these emails, heck, just unsubscribe. I don't want to spam anybody. All right, so the chart of the day, the retailers, the RTH, very, very critical. As I always teach members, we always want to use multi-period charts, meaning weekly charts, monthly charts, daily charts, intraday charts, a mixture of all of them to give us a feel for where the stock has been, what are the probabilities for where it's moving forward, and then we can determine how and if we want to trade the shares. Now, the retailers are a critical component to the U.S. economy. Because let's face it, the Federal Reserve relies upon the U.S. consumer to keep the economy aloft. And when the consumers stop spending, look out below in this economy. That's why they cut rates. So as you can see here, the retail holders, this is a weekly chart. Now, on a weekly basis, I see some bullishness and I see some bearishness here, and we're not going to know which way the retailers are going to go on a macro basis, that 30,000 foot view, which is the weekly chart, until it proves itself, either proves itself bearishly or bullishly. So to identify the lines in the sand that the retail holders must hold as support and or break out as resistance, let's update the chart to identify where we've been and where we might be going. Okay, so let's state the obvious. The retail holders have been in a long-term bull market, and that bull market, while it's come under pressure every several months or so, it's still in an uptrend. However, it's under pressure once again. What are we seeing here? Okay, so the bigger picture, here's our upper band of the rising uptrend channel. Here's our lower band, but we're beginning to see divergences form. And they're taking the shape of lower highs. Now, back in August of 2016, we put in a high of $80.55. We pulled back, held support at $71.86. We rallied off of that support level, consolidated, a beautiful breakout, but now what we appear to be doing is we appear to be putting in a lower high. This most recent high is $80.29. In and of itself means nothing until, of course, we begin to break down and make lower lows. Now, that lower low will occur on a breakdown below the lows seen the week of January the 30th at $75.72. If we break that support level, we're going to come back down and retest this lower band of support in a heartbeat. Now, why am I sounding somewhat dire about the retail holders? Why am I talking about them this evening? Why are they the chart of the day? We're seeing long-term divergences setting up here. The MACD, while the shares of the retail holders have been putting in higher highs and higher lows, the MACD has been breaking down, putting in lower highs, and it's poised to now possibly go negative. Now, what really brought the retail holders to my attention was not the weekly chart. It was actually the daily chart. But being a multi-period chart guy, I had to take a look at the weekly chart out of habit. Daily chart. Now, I discussed this chart last night with members for the first time in a long while on Market Wrap, and I'll be segueing into Market Wrap immediately following this commentary, so members stay tuned. So on this daily chart, you could see, as I mentioned with the weekly chart, we put in a high on August the 15th, a 52-week high. Our most recent high was on February the 21st, and it's a lower high. Now, the problem here is that while we don't have a real significant technical breakdown on a weekly chart, we do on a daily chart. Remember, what I just mentioned on the weekly chart was that we have a lower high, and that if we broke down below a key support level, that we would have a really serious technical breakdown on our hands on a 30,000 foot view using the weekly charts. The daily chart, we have already broken down below but on a daily chart, we have already broken down below a prior low. So we have a lower high, and now we're putting in lower lows on the retail holders. Now, as I mentioned to members last night, we expected further downside today, and this candlestick here is called a bearish key reversal. Quiz question. And a bearish key reversal is a bearish candlestick. It implies that we will see lower lows and that the next support level will probably be $78 per share. If we break that level, we're coming back down to the 50-day moving average, which will coincide with the lower band of the rising uptrend channel. And that's it, folks. If you folks feel like taking the quiz, please do so. If you have any questions, send me an email. Members, let's segue into Market Wrap for March the 7th. Have a great evening.